Okay, I've been asked to do something on monetary policy. Here's a go at 10-minute quick run through of monetary policy. I mean, monetary policy is quite a big topic. So what I'm going to focus on here is what you need for AS level. I mean, in principle, monetary policy as a whole, if you look at the kind of role of the Bank of England, I mean, it has a very wide-reaching remit, including kind of printing money and so on. But it's two overall jobs are one to create what's called monetary stability, and that's what we're going to focus on today. Which is the idea that we try and create a relatively stable value for money. And what this basically boils down to is keeping inflation under control. So that's monetary stability. The other form of stability that has recently become more important is the idea of financial stability. But for the AS level, you don't really need to understand very much about that. It's about stability of the banking system overall, and the job preventing banking bubbles and bank collapses, and so on and so forth. So what we're going to look at today really is the job of the Bank of England, in particular the Monetary Policy Committee, to create monetary stability. So to try to create inflation under control. So this job broadly belongs to the Monetary Policy Committee. The Monetary Policy Committee is made up of 9 members who meet once a month. And what that means is that monetary policy is relatively flexible. Because they're meeting once every month, then they can make decisions. They can change the direction of decisions quite quickly if they need to do so. The 9 members, 4 are appointed by the government, 4 are bank insiders, and 1 is the governor of the Bank of England. So you got a mix of expertise. And in terms of what they're trying to do, the government has assigned them really a main target and a subsidiary target. The main target is inflation control. So the Bank of England, the Monetary Policy Committee, needs to try and ensure that inflation is around 2%. As close as possible to 2%, other things being equal, and they have a 1% margin for error either way. So it's 2% plus or minus 1. And what that means is that the inflation target is symmetrical. So if inflation goes above 3%, that's as bad as inflation going below 1%. And the rationale for that is relatively simple. And what it means is that if inflation is being pushed above 3%, often that's because demand is growing too quickly in the economy. If inflation is in danger of falling below 1%, then the implication is that there's a risk of a recession here because demand is too low. So the target isn't to create inflation that is to stop prices rising at all. It's not to create inflation that's as low as possible. It's to ensure that prices are rising by about 2% a year. Within that role, the Bank of England, the Monetary Policy Committee, is accountable to the government. So what that means is that if inflation is outside of those 2 bands, in other words, it's more than 3% or below 1%, the Bank of England has to write what's called an open letter to the Treasury, the government, the Treasury, explaining why inflation is outside of the target, what's going to be done, and when it's going to return to target. So the idea is that they have some sort of public accountability. So I mean, the key question then is, well, what is it that how is it that what tools does the Bank of England have to achieve these? And the Monetary Policy Committee, and the Bank of England generally, they can control both interest rates and the money supply. Control of the money supply is done through what's called QE, and again, that's not something that we're going to look at now. This is something that we'll look at later in the course. When we look at when we look towards the kind of the bigger picture. So for now, we're just going to look at the role of interest rates in controlling inflation. So essentially, the Bank of England has a view as to the channels through which a change in interest rates today will impact on inflation in the future. And it's worth bearing in mind that the Bank of England's primary target is 2% inflation, but it also has a secondary target, which is to try, where possible, to support the government's objectives for growth and employment. So as long as in other words, it might ignore the fact that inflation is above or below target for now if it doesn't think that this is particularly important, if it doesn't think that's particularly serious. So, for example, at the moment, at the moment oil prices have been falling falling quickly for the last couple of years. That's led to a situation where inflation is well below target, but the Bank of England is basically ignoring this and kind of saying, well, it just doesn't matter, because oil prices will return at some stage into the future. I don't want to cut it. I don't want to try and bring inflation back too quickly. I don't want to push demand up, because the danger is that will create inflationary pressures in the future. So they've got to look. They've got to. It's a mixed target. So the primary target is inflation. Secondary target is growth and jobs. Okay, so how is it? I mean, if you look across the world, probably most governments are more worried about the risk of deflation than the risk of inflation. Although there is some recovery from the financial crisis, demand's still low in lots of places. So let's suppose the Bank of England or any central bank was faced with a situation where what it wanted to do was it wanted to prevent deflation. So the way, so deflation would mean literally negative inflation, in other words, falling prices. Or maybe it wanted to stop inflation from falling. In other words, falling inflation is prices are rising but more slowly. Suppose it wanted to push inflation back up towards the 2% target. Basically, the way that it would do this is it would need to stimulate demand within the economy. And the way it would do that is it would cut interest rates. So the question is, how does a cut in the Bank of England's base rate, how does that impact on inflation generally? And on demand in the economy. So the first thing we can say is that when the Bank of England cuts its interest rates through a variety of mechanisms, this is likely to affect market rates, the rates at high street banks and other financial institutions. And let's suppose that there is a decrease in interest rates. The way the Bank of England sees this as working is that there are a variety of channels through which this is going to occur. So firstly, it's going to increase domestic demand. So demand within the economy. And primarily we're talking about C plus I here. Consumption plus investment. So why are consumption and investment going to be increased? So if we take consumption, then consumption is going to increase because, most importantly, there is a decrease in mortgage repayments. So people who have existing mortgages, they need to pay less back on any given loan. Secondly, obviously, borrowing is cheaper. So it's costing, using credit cards and so on is costing less. Thirdly, there's a disincentive to save. So there's less point in saving money. And thirdly, there will also tend to be an effect through asset prices as well. So when interest rates are low, people tend to buy shares, or the cost of borrowing houses and so on. Will also be lower. Those asset prices go up, creating confidence and wealth. Secondly, it's likely that there's going to be an increase in investment. So why is it that investment's going to rise? Investment's going to rise because, again, borrowing is cheaper. So it's cheaper for firms that are wanting to borrow money to expand. And secondly, there's more reason to invest. The increase in consumption means that there's more point in expanding your capacity, taking on new premises and so on. The other effect is the one that students tend to forget, which is that a cut in interest rates will also tend to devalue, depreciate the exchange rate. And the reason for that is that if there's a decrease in interest rates in the UK, what's going to tend to happen is that there will be an outflow of hot money. So money will move towards countries where there can be where it will generate a higher rate of return. The impact of a decrease in the exchange rate is that in foreign currency terms, the price of exports goes down. So if you were coming to Dover Brooks and the pound gets weaker, so £1 falls from, say, €2 to £1 equals €1. Then effectively, paying your Dover Brooks fees has become, if you're coming from abroad, has become much cheaper. But similarly, if I'm only getting €1 for my pound and I want to buy something from the Eurozone, the price of imports has gone up. And what that's going to do is it should increase exports and it should reduce imports. As a result of which, all of these things what they're going to do, is they're going to increase AD. That directly increases the costs of imported raw materials. So what you've got, running out of space. So what you've got is you've got both demand pull and cost push. You can't read that. You've got both demand pull and cost push pressures. So both of those, in turn, are likely to lead to an increase in inflation. So you can show that. You can show that fairly simply using using some form of ADAS diagram. I mean the simplest one obviously is simply to have some sort of AD function there. Output at Y1, price level at PL1. AD rises to AD2. The economy gets closer to full employment. And as a result, we start running short of resources like land, rents start to rise, or skilled. We start running out of skilled workers and so on. So that's the impact of the increase in aggregate demand. Secondly, we said there's an increase in the price of imports, and the way you can show that one is via some sort of cost push style argument. So again, the price level is pushed up from PL1 to PL2. Output falls from Y1 to Y2. So there's a variety of things that are going on there. So that in itself is relatively straightforward. The trick for the Bank of England is to know how much to cut them by. So monetary policy is fairly flexible. They can cut or increase interest rates by about 0.25% a shot. But our issues are, firstly, we could argue that there are significant time lags, within the system. If the Bank of England cuts interest rates today, it's not going to have an impact immediately. Well, it will start to have an impact immediately, but it's generally 1 to 2 years before it has its full effect. Secondly, in the UK and the Eurozone and Japan and many other places, interest rates are already close to zero. So whilst we might be able to increase them, it's quite hard to reduce them. It's very difficult to have negative interest rates for any sustained period of time. And that's why QE took place. If you look at the individual channels, consumption might not increase because you might argue that there are confidence issues with consumption. That people aren't going to borrow because they don't feel confident about the future. That also you're killing savings, you're killing savers, so their income from assets and so on has been reduced, so they're less able to consume. So people are living off their savings, they're not looking so good. Same argument with investment. Again, although in principle, this should help to stimulate investment. Confidence and investment, a big risk. So therefore, it might not take place. Exchange rate, there's no guarantee. We studied exchange rates separately. But there's what's happening to other countries' interest rates. Is going to be just as important. So if interest rates in the UK fall and interest rates elsewhere fall, then again there may not be very much impact on on the UK's exchange rate as a result. So in principle then, the Bank of England can change interest rates at any given moment in time. They can meet once a month. They're looking a year or two into the future to forecast what inflation is going to be. They don't have to respond immediately. So for example, if inflation was above target, but it was because of cost push reasons. In other words, if we had if what was going on in the economy was that something along these lines, and this was true during the middle of the financial crisis. There was back then there was an increase in oil prices. So what had happened is that inflationary pressures had been created. the Bank of England wasn't very keen on increasing interest rates because it knew if it did so, it would push the economy even further into recession. It would take, we'd gone from A to B initially, we'd end up at C here. With output falling even further to Y3. So they simply took the view that this wasn't a very sensible thing to do, that inflation, oil prices at the time had gone up, they were bound to come back down again. So there's no point in pushing the economy from B to C. It was better just to wait, which is exactly what they did. So that's kind of 15 minutes. I probably better stop there. But that's the broad outline. So the key is, can you explain how interest rates will affect both aggregate demand and inflation? And within that, can you explain why they might not? In other words, what some of the reasons are that a change in interest rates won't necessarily feed through to either domestic demand, foreign demand, or import prices.